Hi, and welcome to Business Advisory and Tax Tips. Today we'll be talking about, is this the week for the second stimulus? And I also have my special guest back with me to talk about different types of investment accounts. I'm Michelle Burke, coming to you live from Annapolis, Maryland. Many of you know, after 30 years in public accounting and the corporate tax world, I went out on my own and formed Health and Taxes. There are only two things certain in life: death and taxes. I'm here to be your business health and wellness growth advisor. I come to you live every Wednesday at 5 p.m. Eastern to give you a little bit about the stimulus and maybe give you a little bit business or tax tips. Please note that this business or tax tips is not meant to be in any way actual tax advice or financial advice. With that, on Monday, the Democrats came up with a new HEROES Act 2.0, $2.2 trillion draft bill. So with that, in that draft bill, we know that the second stimulus check for $1,200 was in there, along with $500 per dependent. We also know unemployment at $600 a week was in there through the end of the year. We know that to lower it from the original $3.4 trillion of the original HEROES Act, that hazard pay for essential workers was cut, renters assistance was reduced, homeowners assistance was reduced, post office funding was reduced to $10 billion, and state and local assistance was also reduced. So given all that, the House will be voting on this bill tonight. That said, Nancy Pelosi was negotiating with Steve Mnuchin, head of the Secretary of Treasury, earlier today. They were trying to get agreement on this draft bill before it went to the House, because Steve Mnuchin kind of represents the White House in whether the White House will approve of this bill or not. So we're trying to get an agreement, because if there was agreement between the two of them, it would be more likely to make it through the House, through the Senate, and through the President. That did not happen. However, they're saying they're going to continue negotiating on it and trying to reach an agreement. So stay tuned. We'll see how this bill does in the House today. Hopefully it'll pass and then go on to the Senate, or perhaps it'll continue to be negotiated. So once again, no results for all the taxpayers standing by out there. You have to continue to be on the lookout and continue to tune in. I'll keep you up on what I hear and how things move. So that's what I have for you on the stimulus. Now I want to move over to talking about different types of investment accounts, especially kind of tax-deferred investment accounts. Let me bring my guest on here with us. So welcome, Jeff.
Thank you, Michelle. It's a pleasure to be with you again.
Absolutely. So first, let me just give you a little bit about Jeff in case you weren't able to join us last week. Jeff McMahon is with LPL Financial. He's a wealth advisor. He graduated from Carnegie Mellon University with a BS in managerial economics with honors. It's his 37th year in the financial services industry, and it's his 23rd year as a licensed financial advisor. He's worked for some big names: Merrill Lynch, Morgan Stanley, and Wells Fargo. He won the coveted National Sales Director and Rising Stars Award while at Morgan Stanley. So last week, Jeff and I talked about short-term capital gains and how they were taxed at ordinary rates versus capital gain rates. So they're not tax beneficial for short-term gains. However, we're going to be talking about different types of accounts that you can have deferred earnings in, and you can actually defer your short-term capital gains within those accounts. So with that said, welcome, Jeff.
Thank you, Michelle.
So I'm going to jump in. I've got a handful of different accounts I want to talk about, but first I want to just talk about your Roth IRA. And as I talk here, Jeff, feel free to jump in with any comments you might have. But just a Roth IRA, for most of you, I want to make the note that a Roth is funded with contributions of post-tax dollars. It's not a qualified plan. A qualified plan is a plan that follows ERISA rules that allows for tax-deferred contributions. So when you contribute it in, you get pre-tax dollars. So it's not a qualified plan. Therefore, as you put money into your Roth IRA, those contributions, you don't get a deduction today. They're taxed if you take them all out after 59 and a half. Not only are your contributions, but also your earnings are tax-free. If you were to take money out of your Roth today, prior to reaching that 59 and a half, you can take your contributions out because it doesn't have a tax impact. However, you can't take your earnings out without a penalty or paying tax. That said, for first-time home buyers, there is a special rule out there where they could take out A, their contributions tax-free, and B, up to $10,000 of their earnings tax-free to purchase a home. And that is something that you should be thinking about if you're a first-time home buyer, especially if you're saving. It's a good place to save if you're saving to buy a house. And the only thing I will caution you about, you should be saving for a home, and you should also be saving for retirement. If you're putting all your money in one nest egg for retirement and then pull it all out to buy your first home or buy a home, then you have nothing for your retirement. So keep that in mind. You might want to keep two different funds or keep separate funds or be tracking in your mind. But that first-time home buyer is something that you should be thinking about as a way to buy your first home. Jeff, anything you want to comment on that?
Yeah, you hit the nail on the head. Roths offer some good flexibility. The investors allowed to add $6,000 per annum into the account, $7,000 if they're over 50. So you touched on the right issues. If your only savings vehicle is a Roth, you probably would not want to sit down with someone, with a real estate professional, and fund your next real estate purchase with your Roth. However, if you are in your 401k and you are on their match and you have a significant nest egg in there and you do have some savings in a Roth IRA, it can be a useful vehicle to sit down with your real estate professional and see if you can add a little bit more cash flow to the at least the down payment on the home, which is critical for a lot of buyers. Yeah,
that's a really good point there, Jeff. So let's talk about for a moment a traditional IRA. The traditional IRA is very similar to the Roth IRA in that it has the same limits that Jeff just mentioned, for 2020 being that 6,000, or if you're 50 plus, you can add another 1,000. It actually has some lower income thresholds. There are income thresholds on a Roth IRA as well. I won't go into specifics, but just know that they're there. The benefit of a traditional IRA or a pro is that it's tax-deferred contributions, but you don't have as much flexibility. Because of that, you don't have as much flexibility in pulling out your money anytime that you want. It would be subject to penalties if you just pull it out. Moving on, though, to the 401k. 401k plans are often, you're familiar with them through an employer. An employer sets them up. The employer gets deductions for any contributions they contribute on your behalf. The employee makes contributions to the 401, pre-tax dollars again. The earnings and the 401k contributions are all taxable post-retirement. If you were to pull them out early, they would be, unless there's some very specific times when you can pull them out early without a 10% penalty, but normally there's a 10% penalty plus you have to pay the taxes on them, because remember, they're all pre-tax dollars. You haven't paid any taxes on them. So there's not as much flexibility. The limits with a 401k is annually for 2020, $19,500. Plus, if you're over 50, you can do a $6,500 catch-up. Again, 401ks are ERISA. They're qualified plans. And so you're a little bit restricted on what you can pull money out for. Any other thoughts on that, Jeff?
Well, you're on the right track. I would say to the viewers, don't forget that a 401k is available to a self-employed person or a sole proprietor in a brokerage account offered by a firm such as LPL. So it's not restricted to just the employer that you happen to work for. I would recommend sitting with your tax professional and getting an evaluation of whether that account is for you, because it is available and it can be very useful.
Yeah, that's a really good point. And another point I might make is if one spouse is in a 401k, but the other spouse either isn't working or doesn't have one, they could still contribute to an Roth IRA or a traditional IRA. There are income thresholds that you have to look at the married level, but it's still something that you could still possibly be saving in. So I just want to make sure people are aware of that. Let me just quickly mention 529 plans. 529 plans are also a way to defer income within the earnings within a plan. So the 529 plans also come with state credits. So Virginia and Maryland offer credits for those, so the earnings are not taxable, which gets me to a point I meant to make earlier. Last week we talked about short-term capital gains, how to grow short-term capital gains, and then in any of these plans where we're talking about investment earnings, those earnings aren't currently taxed. Those are deferred to the future when you pull them out. So if you generate short-term capital gains in any, or short-term capital gains or losses, but short-term capital gains in particular within any of these investments that we're talking about, these types of accounts, you don't pay current taxes on those. Anything to add to that, Jeff?
Yeah, I think you're on the right track. I think 529s offer very good state credits. If you have children, certainly 12 years or younger, you should be meeting with your financial advisor and looking to fund those accounts. In addition, they have estate planning benefits that are substantial, up over six figures, up over $100,000 for families that are looking to somewhat shelter capital, as well as getting the benefits. So there's kind of a double hit on the 529, so they should not be overlooked.
Yeah, and it's really a great way to get you a little bit disciplined also about saving for the needs of your children or grandchildren for their college. We took advantage of them and highly recommend taking a look at it, and because the cost of going to universities is quite expensive, and any little additional benefit is helpful. Let me talk a minute about conversion. So you can convert from a 401k plan, you can convert from a traditional IRA to a Roth IRA. When you do that, to convert, it'll be a taxable event. So many of you might ask, why would I do that? Wouldn't I lose a lot of the benefit? But there are reasons that you might want to do that. One, we know that tax rates are at the lowest for individuals as they have ever been. They're definitely at some point going up. So whatever your horizon is for retirement. The other thing to think about is an unusual thing to think about, but if you have a spouse that's unwell, and you know that someday in retirement you might be a single person, and I hate to put it out there, but it's something to think about. You might be a single person, your rates probably are going to be higher if you continue earning. So it's another reason maybe to make a conversion into a Roth IRA. But then that Roth conversion, I just want to make you aware that it is out there. You can do it. Some people are, as you are unemployed, losing your 401k, you're getting access to your 401k assets. You can roll them over into another IRA, and that could be a traditional or a Roth IRA. Any comment on that, Jeff?
Yes, two. The age, I think, is critical to part of that decision. In my opinion, the younger the holder and investor, the better odds of recouping the taxable hit that you're going to take in the taxable event that you pointed out. And also, I would not recommend to anyone that they initiate a Roth IRA conversion without the guidance of a experienced tax professional. It's a long-term decision. It probably is only going to be done once, and it's not an easy decision. There are some calculations to be made. So an experienced tax professional is almost required to make that decision.
Absolutely. There's a lot of analysis that needs to go into it to make sure it's the right decision for your specific set of facts. So yeah, I second that, Jeff. One other account I wanted to mention is the MoneyPurchase pension plan. This is where you have defined contributions, similar to profit sharing, but it has a fixed percentage. So a company, either sole proprietor or an S Corp, or however you form doing your business, you can consider this MoneyPurchase plan. The only thing is you need to choose a fixed percentage of how much you're going to contribute to that plan. It's not based on the annual profits. So some plans that we know they look at the profits for the year and they make a determination as to how much they're going to contribute based off of how performance was. But that said, some people like the definitiveness of a defined benefit, a defined contribution, and especially if you're just a sole person, as a sole proprietor. So I just want to make people aware that those are out there. Jeff, anything further on the MoneyPurchase plans?
I think MoneyPurchase plans are very underrated and very underutilized. They are very good ideas for sole proprietors, as you mentioned, particularly sole proprietors with high incomes. So if you're a sole proprietor and your business is rocking and rolling, and maybe when things get back to what we would consider normal, we'd have more folks in that circle. Again, sitting down and reviewing whether a MoneyPurchase plan is appropriate for you with a tax professional can lead to very large tax savings.
Absolutely. And so then the last plan that I wanted to mention is the SEP plan. It's the Simplified Employee Pension Plan. So a lot of you have heard that. Again, a sole proprietor, an S Corp, a business can set up these SEP plans. It provides a maximum of $57,000 to be contributed as of 2020. But that's also based, let me say that again. The lesser of $57,000 or 25% of compensation. So as a sole proprietor, if you're giving yourself compensation of $100,000, 25% of that would be $25,000. So it'd be limited to $25,000. One of the great things about a SEP plan is you could decide that I'm going to put in a fixed amount every month all year long, so that I'm kind of doing the average costing. There's ups and downs as I'm hitting the market. It's very volatile, as we know this year. So you could say you're putting a fixed amount, and then at the very end of the year, right up until the time that you're filing your taxes in April, you can look to see, how much comp you paid yourself, what the 25% limit is, and perhaps put in more. So you could do a catch-up or a true-up payment into your comp plan to kind of balance out your fund, play with your tax position, because those are tax deductible from the business point of view. And then again, earnings in there are deferred. like we've been saying about all these other plans. You can either, your investments in there, you can either put them in mutual funds or you can self-direct. You can choose the exact funds that you want to invest in or stocks that you want to invest in. So a very good way for, you know, people out there. Let's talk about realtors. If you're out there and you're just investing in real estate, you really should consider maybe diversifying your portfolio in a SEP plan or a money purchase plan or a Roth. All of these are other ways to expand your diversification and plan for your retirement. Jeff, anything you would like to add about SEP plans?
Yes, I agree completely with your opinion on industries such as realtors as terrific candidates for a SEP plan for the exact reason that you gave, which is most of them understandably have their personal assets tied up in real estate. I'm sure they've done very well, but in the interest of diversification, and certainly everybody can use a tax deduction on their income if they're doing well as a realtor. I'm always surprised that I don't have more realtors knocking on my door to explore a SEP IRA. From an investment standpoint, this is kind of the meat of my part of this conversation, is that the SEP IRAs and the rollover IRAs typically provide me as the advisor and the assets for the investor to perform some of the techniques that we talked about in last week's video, primarily because the assets are in these accounts. So you can build wealth very quickly in a SEP IRA if you stick to it and you stay with it. And certainly if you've left an employer or two and you're able to roll over those assets into a rollover IRA, that gives us the capital to start investing in the equities that we talked about. And one of the strategies we talked about in the non-qualified or non-IRA environment was shorting options against the stocks that you own, which in the non-IRA environment generates short-term capital gain that you so aptly described to us last week. But in the rollover IRA or the SEP IRA, the investor will escape that short-term liability altogether. So these are very effective accounts to start earning. We'll just call it capital gain because the word short-term goes away. And I think investors like capital gains, and we have strategies that generate them in good markets and bad. And in rollover IRAs and SEP IRAs, they escape the taxability, and that's not the worst thing for an investor.
Absolutely. And Jeff, one of the things I want to point out to our audience is, you know, you can go out there and choose to just go in low cost mutual funds. You can choose to not keep an eye on your investments. You can choose to manage them themselves. But I'm just here to say someone like Jeff, a wealth advisor, who's all these years of experience, can really help guide you and help you make some of the best choices within these different funds on how to diversify, what to do, how best to maximize profits and losses. So there's a big benefit to using a wealth advisor versus just the low-cost mutual funds. One thing I do want to tell my audience before we wrap up here is I forgot to mention required minimum distributions. You hear that a lot when you're talking about retirement funds. All the qualified plans have required minimum distributions when you hit 70 and a half. You think that's not a big deal, but there are a lot of people who actually don't want to be forced to pull money out of their qualified plan when they hit 70 and a half. They want to keep it for estate planning reasons. They want to keep it for whatever reasons. So I just want to point out a Roth IRA doesn't have that required minimum distribution. And on that, as we wrap up here, Jeff, is there any final word, anything like you'd like to say to our audience?
Well, I'm glad that you brought up that RMD. In my opinion, investors got a raise moving that age up from 70 and a half to 72. 2/3 of all Americans that live to be age 80 have outlived their financial assets. So the name of the game is to leave your assets in your retirement account for as long as you can before their government employs that required minimum distribution. So in my opinion, investors got a raise with that change.
Yeah, so that's a good point. I'm under the old law. Jeff reminded me with the 2018 the new bill that it is 72, which is a really good point to make. So with that, Jeff, thanks so much for coming on. Thanks for sharing a lot of your knowledge in this area. I'm sure our investor would like to be able to reach out to you if they have any questions. What's the best way to get a hold of you?
My email is the email that you have so accurately displayed on the screen. It's jeffrey.mcmahon@lpl.com. If you'd like to speak with me personally, I'm always available to speak at area code 302-383-9684.
Wonderful. So if you have any financial advice questions or need someone to help you with financial advice, please reach out to Jeff. Meanwhile, if you have questions on tax, please feel free to direct message me, comment below, or reach out to me directly, and I'm happy to help that. If you found value in today's show, please make comments, let your friends know, share the video. It's also on YouTube. Please share that and comment as well. Otherwise, we will be back with you next week with the next episode of Business Advisory and Tax Tips, 5 p.m. Eastern on Wednesday nights. So thanks, everybody, and thanks, Jeff, for joining me again.
Thank you, Michelle.
Bye.